Coming up on today's show, stocks finish higher for the fourth week in a row, why some say the Magnificent Seven will continue to outperform next year, investors pouring back into the market, oil falls as OPEC delays their meeting, Bitcoin breaks out, and is COVID 2.0 on its way. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. Hope you're all doing well, and happy Thanksgiving week to my North American friends. My name's Jared. I'm going to get you guys all up to speed on the latest in financial markets, everything that's going on this week, and since it was a pretty quiet day on Wall Street, we're going to do a special looking at the weekly charts today, and I'll give you guys a bird's eye view of where all the most important markets are, and you're really going to understand what's going on out there. And so being Black Friday, only a half-day trading session, the market's closed at 1 p.m. today. Really low volume, low volatility day. We just grinded a little bit higher with a bit of a pullback in the mega cap tech led by Nvidia. The best performing group today was actually healthcare and vaccine stocks on the back of a potential outbreak coming out of China again, all of which I'll get into a bit later as well. And just looking on the daily chart at S&P 500 here, we only traded in an 8-point range today, really coiling up. Didn't quite reach year-to-date highs this week. However, it looks like there's a good chance we might next week, as that's only 48 points away on the S&P 500, less than 1%, till we hit new year-to-date highs. The Nasdaq Qs are just sitting slightly above their year-to-date highs, and it was mega cap tech that pulled back the most today, with the Magnificent 7 down 0.78%, and the winning group today was actually microcaps up over 1%. But stick with me because we'll come back later and dive into the weekly charts so we can see what all the trends are across markets. First, let's just go through some research and news so we can kind of gauge where markets are at the moment. And so we're just coming off the back of a multi-week rally and gone from a very technically oversold into a technically overbought situation really quick, with a lot of breadth and volume coming into the market, some really violent gap ups and stocks that have been beaten down, trading really hard up off their lows. And that's been thanks to some softer than expected inflation data, which has helped bond yields pull back. And we've also had some really good earnings, with Q3 earnings season as a whole coming in above expectations, and looks like the recession in corporate earnings could be over and they're getting back to growth. And there is a bit of breadth out there in global equity markets and a lot of sectors participating in this rally, and the market's really banking on the Fed being done and not hiking rates any further. And that's a theme developing throughout the world, with a lot of central banks looking like they may be on pause now. And so that's good for stocks, because the higher interest rates go, the more yield investors can easily get from the safety of bonds. So the stock market loves lower rates, and that's what they're really banking on next year. And so now the market, commentators, analysts, fund managers, and all alike are beginning to develop a consensus to buy stocks, with one strategist saying investors should buy stocks ahead of 2024 rate cuts, and going into that period from when the Fed goes on hold to cutting rates, because in the last 4 times the Fed stopped raising rates. From the 12 months forward after their last rate hike, the average gain in the S&P 500 was 17.4%. And so that's why we've seen a huge rally in stocks over the last couple of weeks, as the Fed fund futures market dropped the chances to 0% that the Fed would hike again. And that caused some big buy signals and algos and a lot of investors to come back to the market, because they're looking at past data and historical patterns that show that quite often stocks will rally when the Fed goes on pause, and it's not typically till the Fed starts cutting rates when the stock market rolls over. And we've even got Goldman Sachs saying the Magnificent 7 tech stocks will continue to outperform the rest of the S&P going into next year, saying they've driven the bulk of the stock market's gains this year and they'll probably do the same next, citing faster growth rates and reasonable valuations. And it's true, because analyst estimates show the mega cap tech companies growing sales at a compounded annual growth rate of 11% through 2025, compared with just 3% for the rest of the S&P 500. Also pointing out to the fact that mega cap tech stocks reversed their big crashes from 2022, with big falls in like Meta, which fell 70%, Nvidia dropped 60%, and Amazon's share price was cut in half last year. So they've made up for lost ground pretty good. And Goldman Sachs has even gone as far to say there's no return relationship for the top 7 S&P 500 stocks, with a 30 percentage point outperformance of the 7 mega cap tech stocks this year, relative to the bottom 493 off the S&P, being the second largest annual difference since 1970. But a historical analysis shows there is no relationship between the trailing and forward returns of the top 7 stocks relative to the 493 other ones. So there's a look at a chart of the mega cap 7 stocks here in the candles as a composite, up a huge 102% year to date. And in the orange line here is the equal weight S&P 500, only up 4%. So there's that huge stark outperformance from those 7 large mega cap tech stocks versus the rest of the market. However, if we just zoom out that chart to the start of last year, 2022, we can see that mega cap 7 as a group actually fell 52%. They really underperformed last year, and then they've had a huge bounce back this year. So since the start of last year, as a group, the Magnificent 7 are up 3%. Versus the equal weight S&P 500 down 9.8%. So the spread between the two groups is a bit more closer. Looking out the past 2 years, it's just really this year that the Magnificent 7 have really outperformed. But like Goldman Sachs said, they made up for some lost ground last year. And just zooming out again to the start of 2021, Magnificent 7 are up 51% versus the equal weight up 16%. And again to the start of 2020, just before COVID, Magnificent 7 up 177% versus the equal weight up 26%. And finally, here's a look at the spread over the last decade, going back to November 2013, showing the huge long-term outperformance of America's largest technology stocks, up over 1,000% in the last decade, versus 111% from the equal weight S&P 500. And quite a large consensus that this spread is going to continue to widen going into the future. And who knows, it may very well do so, as those tech stocks do have strong positions and monopolies in their industries, large operating margins in the cloud, growing faster than the rest. However, in my opinion, all of that has been largely factored into their valuations because you're paying a lot more for those high quality earnings than you are for the rest of the market. But a lot of people are banking on AI to take it into a new realm, and they very well may be right. We'll just have to wait and see. So nothing changes people's minds and opinions like price, and especially when price is ripping higher. Nasdaq just hit new year-to-date highs, S&P 500's within 1% of them, and both indices almost back at all-time highs as well. And so naturally that's inviting a lot of people back into the market. However, that can be a bit of a contrarian signal, at least in the short term. The market may be getting close to making a short-term top here, which I'll show you on my charts in a bit. And whilst there's never a perfect time to buy stocks, you can always find a reason not to. There are still a number of important macro factors that could knock the market over next year, including rising corporate bankruptcies and debt defaults, as there are signs in some parts of the economy that the higher rates are starting to bite, especially in commercial real estate, consumer credit cards, and still some issues in the banking sector, not to mention the inverted bond yield curve, and an unemployment rate that's already started ticking higher. And so today's Black Friday. That's the first Friday after Thanksgiving. That's a time when a lot of retailers and businesses will offer deals and discounts on their products and services, and that kind of kicks off the Christmas shopping period into Cyber Monday, this coming Monday, which is the Monday after Thanksgiving, when a lot of online sites and that will offer deals and discounts, and that can be a bit of an economic indicator of how well that performs. It can often give insights into the holiday season because consumers still count for 70% of the economy, and so far this year they've been holding up pretty good. We did see 4.9% GDP growth in the third quarter, coming in a lot higher than expectations, and some pockets of retail have been holding up well. However, there's also some other signals of a slowdown starting to mount, and that's because pandemic-era savings, a key reason behind the spending boom, are dwindling, and there are signs that consumers are becoming more price-conscious. And the retailers got it really wrong last year, with consumers really not showing up in the shopping period, and they were left with huge amounts of inventory they couldn't move and had to slash at clearance rates. And so the retailers got absolutely whacked last year going into this year. And so come early mid next week, we'll have an idea of how they've performed over this weekend going into Monday and Tuesday. And that could give us a bit of a read on consumer sentiment, confidence, and retail spending. And speaking of Black Friday and Cyber Monday, I'm too running a special where you can get up to $1,000 worth of my products and services for free when you order a new trading tool through my link. And there's 7 different tools I've partnered with as an affiliate. These are tools I use myself, like TradingView and Seeking Alpha, which has been a really popular one with you guys signing up, and I highly recommend it for those who haven't if you're serious about stock investing, because just for a few more days you can get 45% off on their yearly plan. Instead of paying $438, you'll only pay $239. And that gets you access to their premium platform where you can just look up any stock, get a huge amount of data and research articles on it, quantitative and Wall Street ratings, all financial data, dividends, valuation. And in my opinion, this site has more quality research than anywhere else online. And that's because for almost 20 years, Seeking Alpha has attracted the best analysts, researchers, and content because they pay writers good amounts to publish high quality articles. And so you'll get investment research houses, hedge funds, investment managers come and write their thesis on a stock. And there's a good community with comments as well. And I've found a lot of nuggets and good investments through Seeking Alpha. I'm a premium member myself, And the small cost of the yearly subscription has paid for itself many times over for me. They also have a cool screener where you can find top-rated stocks, and you can edit the filters to find whatever you want and use their quantitative rankings. To hone in on investment ideas, you can add your portfolio of stocks in there. You can get notified of new news, research. You can listen into earning call transcripts and much more. So if you haven't already, I highly recommend getting access to Seeking Alpha Premium for the next couple of days at $239 per year. And if you come to my website, clickcapital.io, click on the big red banner up the top, and you'll come to this page here, and then make sure you visit Seeking Alpha for the first time through this blue button here. That way they'll know we referred you, and then afterwards just send an email to me at support@clickcapital.io with your Seeking Alpha receipt, and you can get $239 worth of my products and services for free, and you can just pick and choose exactly what you want. I got some custom trading view indicators, an active investment strategy you can follow, and my latest investment presentation on a micro cap stock I've invested in. So that's only for the next couple of days. If you're interested in learning more about that, click the link below this video to head on over to my website. Just moving on through the daily show, we saw Treasury yields tick up a bit higher today in an otherwise slow moving day for markets, and that's after 4 weeks of declines in yields. And we can see that there in the 2-year, jumping up to 495 today, and the 10-year possibly finding support at that 437 level, and that popped up a little bit today to 447, which was a little strange for Black Friday to have that bit of a move there. Also in Fed Fund futures, only a couple of days ago they were giving 0% chance to the Fed hiking any further, and today we're finished with a 12% chance that the Fed may hike in January. However, we've still got a 64% chance that they're going to cut in May, and the Fed has been talking tough on inflation. They haven't officially gone on pause yet. They're still leaving the window open for another rate hike. If not, they want to stay where they are for longer than usual, they've said, until they're 100% sure inflation is going back down to 2%. So whilst it's a strong probability that the Fed is done, and the market and the Fed itself still leaving the window open a little bit that they may not be done. And for clues on that, you want to watch inflation. And one of the biggest drivers of inflation is the price of oil, which goes into a lot of products and services we all use every day. And what's been really helping inflation expectations over the last couple of weeks is the falling price of oil, as we've seen a bit of a pullback in demand and some building oil and gas supplies, on top of the US and some other non-OPEC countries pumping out the black stuff at record levels to counteract the supply production cuts coming out from OPEC+. And they were due to meet this Sunday with speculation and rumor that they were going to extend their 2023 production cuts into next year, as they would like to see the price of oil a little bit higher than what it is now. And so they delayed their meeting by 4 days, and that spooked the market a little bit, because that likely means OPEC Plus members are not in agreement, as by the time they do their official meeting, they've already decided on what they're going to do. And there's speculation that OPEC members Angola and Nigeria are pushing to be allowed higher output levels. They want to continue selling more, and that would mean the Saudis would have to cut more of their own production for the group as a whole to drop their production. And so basically the market is pricing in a higher likelihood of a bearish outcome from this meeting. Maybe we don't see the big production cuts going into next year. So we've seen demand pull back a bit. Still got soft Chinese and Eurozone economies. Bit of build up in US supplies. And the US, being the largest oil producer in the world, still pumping out record daily amounts, is supporting a lower oil price. On top of that, the conflict in the Middle East looks to be going in the right direction, with Hamas releasing some Israeli hostages and Israel doing the same in a ceasefire deal. And that's just happened over the course of this day. And this is something the Western diplomats have been trying to negotiate for weeks. And so for the first time since October 7, Israel's hitting the pause button on striking the Gaza Strip and allowing for an exchange of hostages. And so the threat of this spilling over has gone down as well. And we can see that in the daily price action of crude oil futures, fallen 2% on an otherwise sleepy day across markets. Now sitting just above $75 a barrel. We do have support around the $73 a barrel, which we could indeed test next week. And so like I said, that's helping inflation expectations a lot, which is helping bond yields to come down and stocks to go up. One of the best performing assets since Hamas launched their surprise attack on Israel has been Bitcoin, now within reach of $40,000 a coin, with the market trying to front run the strong likelihood that we'll see some spot Bitcoin and Ethereum ETFs come to the market, most likely in Q1 next year, with the industry seeming to win over SEC's Gary Gensler fight against it. And there's a look at the daily chart of Bitcoin. Seems to be holding the ground above this $35,000 level that used to be resistance, now looking like it is support. We've consolidated for a few weeks and we just broke out today above that consolidation level of 38,000. And just taking you out to a weekly chart, the next big level will be that psychological 40,000, where the market has turned a few times before. And so the Bitcoin rally continues, and it's having a great 2023, up more than 100% this year from where it started, a bit above 16,000. However, Ethereum, the number 2 biggest crypto, has a bit more work to do. Hasn't performed as well as Bitcoin. Has been consolidating. This does look like a bullish chart pattern. We're pushing up against this resistance, which is around that 2100 level. And so the crypto market continues to hold its ground pretty good here. The other big news event this week was Nvidia's earnings, which we got on Tuesday afternoon. They absolutely smashed numbers, blew through Wall Street estimates, seen huge growth year over year, 200%, showing that they are selling a lot of GPUs out there, that the AI boom is real. However, the stock's struggling to get over $500 a share. It's technically stalling out around there, and that could be due to some worries over their ability to sell to one of their biggest markets, and that's China. After we got reports, the chip maker was delaying the launch of one of their new AI chips destined for China till the first quarter of next year. And that chip, the H20, has been designed to comply with US export rules. So basically, the US government is not allowing Nvidia and other chip companies to sell high-end, cutting-edge chips to China on fears that could be used in Chinese military and that the US could be shooting itself in its own foot. So Nvidia's been trying to sell a bit less performance chips in a custom product for the market. However, US regulators look like they may be making them jump through a few hoops for that to happen. However, Jensen Huang and Nvidia management are not saying that's a huge problem, that they can adjust to it. However, they're warning it could get worse if the US government and China extend their economic Cold War. However, we did see Xi Jinping on United States soil a week ago arguing for this Cold War to de-escalate. We're kind of yet to see how the US government and business community responds to that. And there's a look at the daily chart of Nvidia, with EPS coming in 19% higher than expected at $4 a share. We had put in this head and shoulders pattern on Nvidia. We never really got a solid close below the neckline to confirm it, and then we've kind of come up here again, closed above $500 a share for only one day, the only day it's ever closed above 500. And we've done quite a bit of a sharp pullback, especially for Thanksgiving week. That volume and volatility it's had has definitely made it a bit of an outlier this week. However, like I said on Tuesday afternoon, I think it was just a case of the market front-running that great earnings. As it was only late last month, we actually got down below $400 a share and just ripped up to 500 in no time. So the market's probably having a bit of a breather here. We may come down and tag the 50-day VWAP, probably around 460 or so by the time we get there. But I'd imagine we would find some sort of support around this level here, because the growth in the business and the amount of money that wants to get into the AI leader is huge. So it should find support and a lot of buy the dips. But as always, we'll be keeping an eye on it as a key stock for the market. And is everybody ready for COVID 2.0? Ready to go on lockdowns again? Hopefully not, but you may have heard news that there's a mysterious pneumonia outbreak in China, another respiratory illness, and it appears to be serious enough that the World Health Organization has made an official request to China for detailed information on an increase in respiratory illnesses, as apparently they've already got some hospitals starting to get overloaded, especially with children. This is on the back of China lifting COVID restrictions as they go into the cooler months. And so right now it's still early days. We don't know a whole lot. Still a lot of unclear information out there. What we do know, there's a surge of respiratory illnesses, mostly in children. However, just like the early days of COVID, China's saying don't worry about it. There's no unusual or novel pathogens, and this is just a bit of a bad winter flu going around. However, if you want to know the truth, just take a look at markets. They are very efficient future pricing mechanisms, mostly right most of the time. And just looking at this group of the 20 largest vaccine maker stocks today, they actually had quite a bit of a pop today across the board. On a day when the S&P 500 pretty much finished flat, and the Nasdaq actually finished down a little bit. On a half-day trading Black Friday, we had a number of vaccine stocks up over 1%, 2%, and 3%. So hopefully this doesn't turn into COVID 2.0. However, the market's starting to price in a little bit of a chance it could. Looking out to some economic data we got this week, saw initial jobless claims coming a bit better than expected. Jobs market kind of swinging back and forth there, but still overall holding up. There's crude oil stock inventories jumping a lot higher than expected. And we got a few better than expected PMIs from the Eurozone. GDP growth in Germany still negative. Canadian retail sales came in a bit better than expected, and then some manufacturing and services PMI from the States today. A little softer on manufacturing, still in contraction territory, but services and the composite PMI coming in a bit better than expected in expanding territory. There's the fear and greed index climbing again to 68. A week ago we're 58. Markets starting to get back to that bullish consensus. A lot of money coming back in. I'd say we're getting close to a technical short-term top here, and adding to my conviction in that is corporate insiders taking advantage of these elevated prices and doing a bit of selling up here. We can see on Wednesday 238 sales were logged against 94 purchases, and they typically have a history of selling the rip, buying the dip. And I can see on my institutional buying percentage indicator, we're in the neutral zone at 46%, but really close to the bearish zone, but below 45%, with my S&P 500 oscillator at 64. That's been a little persistently overbought, which can last a few weeks like we saw back in June going into early July. However, we've done a huge 450 point rip since late last month, and we're coming up to that resistance level of year-to-date highs at 46.07 on the S&P 500. And so whilst I think we could come up and touch that level next week, maybe have a peak above it, that could indeed be a bull trap fake out, and that could mark the short-term top, be somewhere around 46.20 to 46.40 on this resistance zone. And just switching over to the weekly chart now, that's not too far off all-time highs, which is a little bit above 4,800. Be truly impressive for the market to rip up to 4,800 without a decent 5% pullback or so. And I can see here on my DSI, we're actually starting to form a big bearish divergence on the weekly chart, and just going to the S&P 500 equal weight, looking a little softer again. Looks like it's back into the consolidation chop zone. And then we'll stay on the weekly chart time frame, like I said today, and I'll give you a bird's eye view of all the markets. We can see what the medium term trends are. And so here's the Magnificent 7 with the composite index all-time high at 1951. We actually got up to 1950 today. So this is pretty much sitting at all-time highs, this group of 7 stocks. There's a look at the Dow Jones Industrial. It's coming up to its all-time resistance, and a lot weaker is the Russell 2000. Small cap stocks did find some support at their 2022 lows, but it looks to be well back into sideways market. Moving on to Canada's TSX, sideways consolidation, along with the UK FTSE. Germany's DAX having a really good bounce up, and the weakest of the group, the China 50 index. A lot of people have given up on the Chinese market. One of the best performing markets this year, Japan's Nikkei 225. Didn't fall as much as the rest of the world last year, kind of just consolidated, set up a really good base for a rip on the first half of this year, and here we are sitting back at highs. And like much of the rest of the world, the Aussie 200 has been in a long extended period of consolidation as well. No clearly defined trend. And just like the country's national symbol, it too is in a kangaroo market, bouncing up and down sideways. There's a look at the weekly chart of the VIX. The spike up in COVID didn't really spike up all that much last year, and it got up to the mid-high 30s, and it's just really fallen this year, especially the last couple of weeks. With the market ripping up, we're now sitting at lows not seen since before COVID kicked off. And bond market volatility versus stock market volatility still hovering near all-time highs. Bond market's a lot more worried about the future than stocks. And there's a look at the amount of stocks above their long-term 200-day average. You can see that peaked back in April 2021, really fell off last year. It's bounced back a bit this year, not getting too much above 70%. And here we are now, only a little bit more than half of all stocks above their long-term average. There's a look at NYSE new highs versus new lows, and NASDAQ new highs versus new lows, which up until a couple of weeks ago had been really bouncing back. Growth versus defensive sector spread. Growth versus value stocks have had a really good year, and small caps versus the S&P 500's had a really bad year. Small caps have been really underperforming. There's a look at the weekly chart of the US government bond 10-year yield. It's been in a well-defined uptrend for a couple of years now, and looks to be doing a pullback the last couple of weeks, and can still be in an uptrend, if not a period of consolidation. But there's still a lot more technical work to be done for this to go into a bear market. One of the hardest hit assets this year, TLT, may have put in a bottom in late October on all that volume. Got really technically oversold, and that's had quite a good bounce over the last couple of weeks as well. High yield bonds are holding up better than treasuries. Looks to have found their footing, and helping stocks is the dollar index pulling back as well. And commodities still in a period of consolidation as a whole. They've still got a bit of work to do before we can say they're in an uptrend, and gold just keeps pushing up against this all-time high resistance zone. Seems like in a forever consolidation period, and I still think it's forming a base that it can rally from. However, we need to see that big, clean, strong break above 2100 for that to happen. There's a look at the weekly chart of crude. Looks like to be going back into a period of consolidation. I'd be surprised if it went under $70 a barrel and didn't be able to defend these high 60s again, and that could prove another dip buying opportunity for positions in the energy and oil sector. One of the best performing commodities, uranium, close to breaking out to their 2021 highs. Agricultural commodities as well have held up just this week. They came off a little bit, but we've still got strong performing soft commodities like orange juice, sugar, and cocoa. Over to stock sectors, one of the best performing sectors this year on the back of geopolitical tensions, it's that of cybersecurity. The robotics and AI ETFs had a bit of a bounce back, and semis made all-time highs this week, along with the tech sector as a whole. Contrasting that's the really weak performing clean energy sector, which hasn't managed to have a good bounce this last month. There's the retail sector, which may have found a bottom a month ago as well, and one of the best performing sectors this year, home builders. The financials in a big period of consolidation, and there's a look at the regional banks after getting hit hard in March. After the failure of Silicon Valley Bank and a few others, they've been in a period of consolidation as well. And energy stocks hovering near those highs, along with defense contractors close to breaking out to all-time highs. Also hit hard this year was consumer staples and other dividend yielding stocks like utilities. Got really smashed come early October. They've had quite a good bounce from that level. There's a look at the biggest stock in the market, Apple, coming back up to all-time highs, and Microsoft actually found all-time highs this week. There's a look at the weekly chart of Tesla. It's now been going sideways for almost 3 years, and the huge bounce back in Meta after it got absolutely smashed last year. The back of the street worrying about how much money they're pouring into the metaverse. They went on a cost-cutting mission, which has paid off in spades. And some beaten down old economy stocks like General Motors still yet put in a convincing bottom, along with really hit hard Walgreens. Macy's seems to have had a good bounce, along with 3M, and the telecoms as well have traded up off deeply oversold, undervalued conditions, and the big banks not doing anything too exciting either. Okay, so there we are on the weekly chart of the S&P 500, 4 up weeks in a row, and just going back down to the daily. Like I said, we're only 48 points away from new year-to-date highs. Could very well come up and tag that next week. I'll be looking for the price action around there. If we get any shooting stars, inverted hammers, any sort of candlestick or chart formation, along with some technical divergences to show that we may have put in a short-term top, because I think if we keep rallying up next week, we've already had a lot of people buying calls this week that should be happy. We're seeing signs of money coming back to the market, improving sentiment indicators, and my own custom indicators show we're already into technically overbought levels. So we may have one last final push up there to 46.30, 46.40 before putting in a short-term top, and then maybe having a bit of a pullback, and that could be a bit of a decent pullback because I can see we're 5% above the 50-day VWAP, and that's close to extremes we've seen over the last year, with the biggest being 6.5%. However, for now, volatility risk premium is still negative, a lot of momentum and breadth in the market. Price action looks to be walking the line, grinding higher. There's no real divergence forming yet, and so barring any surprise, I think we come up and trade to new year-to-date highs next week. And like I said, I'll be watching there for signs that we're putting a short-term top. That's all I got for you this shortened trading week. Hope you enjoyed the show. Please hit the like button if you did. And if you want to improve your stock investing, I highly recommend you take advantage of that Seeking Alpha Black Friday sale. It's going to be gone in a few days. You can save 45% and you pay $239 for the year, and you'll get that and the same amount of credit on my website when you buy through my link by coming to my site, clickcapital.io, and clicking on this blue button here. Then just forward your receipt to my email, support@clickcapital.io, and let me know what products of mine you want for free, up to the value of $239. So this is a great deal, only for a couple more days. I highly recommend you take advantage of that. Otherwise, I wish you all a great weekend, and I'll see you again Monday night. Cheers.